Aloha kakahiaka, everyone. Welcome to the Hawaii Realtors Virtual Connect webinar series. Today's presentation is on Housing and the Economic Recovery Part 2. Our featured speaker is Paul Brewbaker. Paul is a principal of TZ Economics, a Hawaii economics consultancy firm. His background spans over several decades, and he has lectured and presented on international, monetary, and financial economics. For your information, a recorded version of this session, as well as a copy of Paul's slides, will be available to all registrants. Lastly, if you have any questions for Paul, please type them in the Q&A box. Now, without further ado, take it away, Paul.
Thanks, Ethel, and aloha, everybody. And I suddenly realized, what is today's date? I have the wrong date on this slideshow. So today is the 19th, I think. And I will change that date on a version of the slides, which will be posted as a PDF by the Hawaii Association of Realtors for those participants who want a copy of the contents. I'm going to talk about 5 or 6 subjects, starting with the current epidemiological situation here in Hawaii and transitioning to a couple observations about the overall economy, and then to drilling down to housing in particular. We'll talk a little about production in Hawaii and then other housing market characteristics that help us think about where real estate is going, residential real estate is going, as we come through this current crisis into the decade of the 2020s. I've animated a bunch of these slides here, so they'll be different on screen while I'm animating than the version you'll get. But all the data I'll include in the PDF are in the animated slides that we get into right now. So these are Hawaii's daily confirmed COVID-19 case counts. Each of the little dots is 1 day's observation. And so just looking at the dots, you can see it's not good right now. I mean, we had things under control at the end of May. In fact, we had many 0 days at the end of May. But things have gotten out of control this summer, and particularly in the latter half, maybe even the last week or two of July, an explosion of transmission and COVID case counts has left us in a situation now in mid-August where we're having to think about pulling back from some of the reopening of the economy that had been unfolding over the summer. It's tough to fit to the data the trends that are underway. If we peaked, this right now turns out to be one of the better fitting estimates, the line you're seeing there in the little dashed line. The early experience was much more consistent with traditional epidemiological models, and this current episode, which is really a second wave, will be, when we look back at it, with any luck, from 3 or 4 months perspective, 3 or 4 months down the road. However, you know, it could look like this, and that's the problem. This trajectory and this trajectory differs by a single term in a polynomial expression. And okay, trust me, we don't want this to be happening, but it could be, and that's the problem. That's why we need to start thinking about how our behavior changes in an environment that looks like this, so that it turns out to be one like this. Let me put it differently. Right now, the situation in Hawaii is, 10 to 20 to, I don't know, what is that? Anyway, way worse than it was back in the spring. Let's put this in some context, because I know we have lots of other examples around us in the world and the country to which comparisons can be made. And it's important to make those comparisons on a normalized basis. So in each of the next data sets, I'm going to take the daily case count. These are actually 1 week moving averages, so we don't have any of the weird variation that happens, more tests on Wednesday and Thursday than on Monday and Tuesday, that kind of thing. So I've got a 7-day moving average of daily case counts, and I'm going to divide by population in each place. So these are per capita estimates, or in this case, cases per million people per day. So there's Hawaii compared to South Korea. And East Asia and most of the Pacific Islands experiences are really examples to which Hawaii should aspire. They've mitigated the initial exposures, and then they've successfully maintained containment. I've heard a lot of talk lately about, ooh, the cases are going up in South Korea. Well, right there at the bottom of the slide, can you see that where the little arrow is pointing? That's South Korea's latest little. So if you're in a situation like Korea where you have a hotspot, you can identify it and go knock it down, you can have the rest of the economy operating in a way that's not possible in a place like we are now in Hawaii, where things look like they're getting out of control and we're having to pull back on parts of the economy. And that's a challenge for us as we move down the road out of summer into the fall with school starting and all the usual stuff. Here's some other country comparisons. There's Germany, Italy. So Hawaii today is worse than Italy back in April. Does that make sense to you? Back in March. Here's Spain. Hawaii is as bad as Spain was at its peak. And Spain right now is having a second wave that's problematic. And Hawaii's second wave is worse than Spain's. So these comparisons are useful because you hear about these other contexts and you think about, here's Brazil. Yikes. In about a week, we could be Brazil. Okay, this is why probably a couple of weeks ago, we should have been talking more about this, but hey, we're talking about it now. So let's see if we can't do something to turn, remember flattening the curve? That's the cumulative curve. These are the daily counts, right? We want to bend this curve back down. That's what we're trying to do here. So that we can say to the rest of the world, this is a safe place to come have your vacation. This is a safe place to come be a tourist. And right now, that's not something that Oahu can say. Neighbor islands are getting dragged through the mud by what's happening on Oahu up in Honolulu right now. Here's New York, which is the gold standard for how bad it could get in the US back in April and how good it can get if you get it under control. So New York today is running at 30 or 40 cases per million per day. Hawaii today is running at about 150 to 200. It's been as high as 300, 350 in Hawaii in recent weeks. So, let's get that thing curved back down. And now here's some other state comparisons, because this is well known. America is just having the worst experience with this for reasons I don't even want to get into. But here's some other comparisons. Again, 7-day moving average of daily new confirmed cases per million persons, per million residents. Here's Hawaii and New York, just juxtaposed. Let's take the other countries out. California, having some trouble, thought it had it under control. It's had renewed trouble in recent weeks, keeps having to fight it back. Arizona in July was New York in April. That's how bad it got. But here's a news flash. Hawaii's worse than Arizona today. So, go act. And the problem, of course, is that Hawaii could be like Arizona in July in another 3 weeks at the rate we're going. Florida, we've all heard about. If you go throughout the South, here's Louisiana, here's Mississippi. Okay, you get the picture. We've started out on our second wave. We don't want it to be like what we've seen in the Sun Belt, and so we have to get on top of it right now. It's already the case that in terms of mortality, those were just COVID cases. But even with our reasonably good healthcare system, I mean, we have reasonably good delivery. We may not be able to actually get healthcare, but another subject. The US is a top 10 country in terms of deaths per capita or deaths per million attributable to the novel coronavirus and the disease that comes from it, COVID-19. So, right, the US is worse than Brazil. The US is almost as bad as Sweden, which has no controls. They're just running this experiment in Sweden, and how many people are going to die? And the answer is a lot. And so we're not Vietnam, which I looked it up. I looked it up a little while ago. Anyway, Vietnam has 95 million people and something like has had 400 cases. I mean, it's crazy low. Hawaii has 1.5 million people. New Zealand has 5 million, and has had 22 deaths. So, okay, there are ways to do this, and other countries are able to, and we should learn from those experiences. Right now, this is from the Hawaii Department of Health. If you look at the pattern of infection, it's coming from community spread. The first wave came mostly from returning residents, people coming back from the mainland. So those cases were travel related, and then travel shut down in the course of March. And we've been on this sort of 14-day quarantine, protocol ever since March 26th. It's still in place. It's going to be in place all through at least September. But the pattern of infection in Hawaii today is coming from community spread, transmission among residents, partly because travel and tourism are so low, but mostly because behavior began shifting in June and July that has increased our risk. So today, Hawaii's transmission rate is about 1.2%. That, as long as that transmission rate is above 1, it means that your infections are going to keep growing. So we've got to get that, what's called RT, the reproduction rate. We've got to get that transmission rate below 1, and we did it back in March and April. So we know it's possible to do it. Right now, Hawaii is ranked highest in the nation for its state-specific RT rate. So this is not good. We've got to change collective behavior. And the problem with that for the economy and for the housing market, residential real estate in particular, is that the more Hawaii fails at containing this coronavirus, the more the asset valuations and the perception of risk in Hawaii's housing market is impaired. We sort of made it through the first wave here in Hawaii, and valuations, we'll see in a second, held up pretty well. But the risk now is that if we keep moving in the direction we're moving, investors will look elsewhere, and Hawaii will be at a disadvantage compared to other housing markets. Now, I've talked a lot about patterns of behavior associated with the novel coronavirus, and we have these amazing daily data sets I'll go through a little bit here, because very often the economic data on monthly or quarterly basis, we'll look at the housing data on that basis. It takes a while. I just got second quarter data, but here it is the middle of August, that kind of thing. Well, these are daily data, and we have them running right up through last week, or in some cases yesterday. These are data from residents' debit card and credit card swipes. So you can see the pattern. I've put two here back to back to juxtapose spending at grocery stores on a daily basis and spending in accommodation and food services. Now, residents don't use that many accommodation services in Hawaii. Tourists do, but these are resident patterns, right? These are people with credit cards with Hawaii zip codes. And so it's mostly food service. So you can think of this as eating at home and eating away from home, which is how, for example, those are segregated in the consumer price index. But again, these are spending patterns revealed by people using their debit and credit cards on a daily basis, people in Hawaii, everything compared to January 2020. So the benchmark is January, and then you look at over time what happened in March. Well, as we became aware of the spread of the novel coronavirus, everybody went out and bought toilet paper, like there's a hurricane coming, which there was, right? Everybody went and stocked up at the grocery store, and everybody stopped going out to eat back in March. And by April, that pattern had established itself. And then we all hid out in the bunker and hid out in our cave for a while. And you can see spending at grocery stores has stabilized over the course of the subsequent several months at about 20% above the January levels. So we go to the grocery store, we spend more money at the grocery store than today and have all summer than we did back in the winter, but eating out is down 20% relative to what it was in January, even though it's come up a little. It had fallen 60%, and then it worked its way partially back up. And here's an important point. The new normal, we don't know what things are going to look like in the future, But it's probable, as you look at some of these areas of economic activity, dining out, retail in general, going to the office, right? It's probable that some of the changes that seem temporary may end up being permanent. It may permanently be the case that food service as an economic activity is permanently impaired relative to grocery shopping. Or maybe not, I don't know. But that's a question for real estate, for commercial real estate, right? Are restaurants going to be as viable tenants in the future? Are the retail outlets, the brick and mortar retail outlets we see out there, going to be as commercially viable in the future? Is housing in the urban core in high density format going to be as attractive relative to housing in the suburbs where people have yards and whatnot? So these are all things that we're thinking through. Here are related data on, these are what are called mobility data. So they're from smartphone movements. So Google is tracking your movement, right? They're tracking your smartphone's movement. And again, you see a pattern where relative to January, we had these patterns of whether we were in our residence, whether we were at the grocery store, whether we were in a workplace or a park. Those are the data sets I've shown here, you know, engaged in recreational activity, right? And you see that immediate split upon the onset of the novel coronavirus where people stayed at home and people stopped going to the workplace. People stopped going out to do recreational activities. And initially the drop was larger and then there's been partial recovery. But again, you get this pattern emerging that maybe things are permanently changed relative to the way they were before the novel coronavirus. And here's an interesting tidbit. We looked at grocery store purchases, the actual spending going up, but you can see that the amount of time we spend at grocery stores is actually 20% lower than it used to be. And that's starting to look permanent. That is to say, we don't go out to the supermarket as often, but when we do, we buy exactly what we need. And we get the hell out of there and get home and take a shower. And you know, that may not be a permanent behavior, but it could very well be that some of these consumption patterns are changing enough that there are implications for real estate, and as I say, commercial real estate in particular, but also for where preferences are about where people want to live. And finally, just some daily spending data. These all come through to about August 8th, if I recall correctly. And by the way, all the links are in the footnotes to these slides, and you can go to these amazing websites, right? These are big data aggregators, so they're taking all the cell phone mobility data, they're taking all the credit card swipes, they're taking internet searches, right, job searches and whatnot, and they're compressing all of that data into a usable format. And then, dude, you just click, click, click. All these graphics are available for you online. It's like, why am I even making my own graphs? So here, a final note from these data sets, right? Healthcare and apparel spending dropped, but have come back almost fully, whereas transportation, and as we talked about before, recreational spending on arts and entertainment, right? Those poor guys look to be, at least for the duration, down dramatically. All right. How does this relate to the novel coronavirus? Well, let's put two data sets together, daily data sets. On the top are Hawaii's case counts, the 7-day moving average, cases per million. And there's that upsurge that we've been talking about. And then on the bottom, I've got total daily spending, again, using these big data from credit card and debit card swipes. Again, you see a little bit of stocking up, a big drop at the end of March. And by the way, the drop in spending, notice that the drop in spending occurred before the governor issued the executive order to stay at home. That is, people's behavior leads. The leaders are the followers. The leaders are validating what people already know they have to do. And again, at the end of the summer now, you see the same thing. Yes, now the mayor finally on Oahu said, okay, maybe y'all shouldn't be going out, you know, hanging out at big family gatherings. And there's a whole list of things there's a totally obvious things that we probably should be doing if the case count is going up. But what's important here is that you can already see prior to that order, which is August 18th, right? Well, these data go through August 2nd. You can already see that bend in the spending. And my guess is that we were going to see, and now when, you know, that we're in the middle of August, we'll observe some partial retrenchment, recompression of the spending that had restored itself in the early part of summer, but then because of the behavior leading to increased coronavirus transmission has induced behavioral shifts. This is how we get rid of the coronavirus. We change our behavior. It means we'll go back into a cave mode for a little bit. And hopefully that'll take care of it over the course of the next, you know, month and a half. I'm thinking if we're lucky, we get to end of September, we get to start again. Now, why does this behavior matter and why is the spending so important? If you look at income, this is national data, but if you look at the patterns of, in terms of sources of personal income, right? These are US constant dollar, I'm sorry, these are nominal dollars, but 20,000 there, these are in billions, so that would be 20 trillion. Just think of it as 20 trillion in personal income minus, like below zero, minus what we pay in income taxes, income tax withholding, and payroll taxes, okay, or income taxes at the end of the year. So you take that 20 trillion, 20 trillion, 20,000 billion, take the 20 trillion, subtract the 3 or 4 trillion in taxes, and you have about 16 trillion net, 16, 17 trillion net. What's important here are the components. So the big component is compensation, right? Earnings from work. And then the next biggest component, what we used to call dividends, interest, and rent. So the asset-based incomes, okay? And then something called proprietor's income. Actually, I've included in asset income, you know, people who get royalties from that movie script they sold. And, you know, so there's any source of income that's coming from property, whether it's intellectual or physical or whatever. And then you see proprietor's income, a thin slice. That's what, you know, business owners earn after expenses. And then transfer payments, which ordinarily are a substantial amount, 3 trillion maybe, that are redistribution from wealthy households to poor households in terms of income maintenance. And in the second quarter of this year, you can see the explosion associated with the CARES Act and a pattern of fiscal policy responses, the big increase in transfers, an injection through the PPP loan program to businesses, and then of course, because people are losing their jobs, compression in compensation and compression, shrinkage in proprietor's income as business drops off. So that's the pattern. Notice through the middle of this year, we maintained income streams through these transfers, and we're literally borrowing, using the US Treasury to borrow from future income to provide income maintenance to people who are unemployed or people who need business loans in the present. So the problem in the second quarter wasn't income. The problem is that our savings rate, which had been falling, right? Remember the boomers' savings rate was falling for 30 years and we all worried about it. And then in the 20 teens, the US personal savings rate rose to about 7.5%. And that was kind of the new normal in the 20 teens. Well, in March and April, with the COVID event, the savings rate exploded. Now think about it for a second. What happens when everybody's, right, the savings rate was 7.5%, and then it overnight jumped to more than 30%. A third of people's income was saved in April. Does that make any sense? We know they just went out and bought toilet paper. So not only did they save by physically stocking up on canned goods, they literally saved you know, a third of their income when it used to be not even an eighth or ninth, or whatever it is, 7.5, what is that, an 11th or 12th? I mean, you know, it's crazy. And this is what people do when they're risk averse and they're thinking about the nature of the crisis and face uncertainty about whether they will even have income in the future. Now, What's the flip side of an increase in saving? Right, a decrease in consumption. And that's where the bulk of the recession that you now see in the GDP data comes from. If you break down gross domestic product into consumption, investment, capital formation, inventory changes, a form of investment, government consumption, and net exports, the pattern in the second quarter, a little bit in the first quarter, which is all March of reduced consumption, but especially in the second quarter, the pattern is dominated by a 25% annualized decrease in GDP attributable to personal consumption expenditure, and another huge chunk coming from investment, coming from capital formation. People pulled back on investing. This is physical capital formation in buildings and equipment and software, right? Not buying and selling stock. This is actually forming physical and knowledge capital. And then a big depletion of inventories, right? Because we cleaned out the shelves of all the toilet paper for several months. So what comes in the future? Well, that's where the GDP growth forecasts are so tentative right now, because we now can see that big drop in second quarter GDP, which was anticipated, and these were forecasts from April and June, right before the quarter ended. Now we know what happened in the second quarter. The problem is, of course, that during the course of the summer, we've had these second waves in much of the country, even in Hawaii, and therefore the expectation that third quarter would have a positive GDP growth rate as we came out of the bottom, right? If GDP falls 30% in the second quarter, then even if it's only down 20% in the third quarter, it's gone up by 10 percentage points, right, on an annualized basis. So that kind of forecast where we come off the bottom and start the recovery, oh yeah, it takes 2 or 3 years to get back to where we started, but at least we started. That kind of forecast has now been pushed down. And the problem is that the second waves that we've seen all across the Southwest and now moving north to places like the Dakotas and the upper Midwest and coming on out here to Hawaii. Not so much in the Northeast, places like New York, where they've managed so far to keep things down and to hold at bay their second waves. Those second waves, unfortunately, suppress the possibilities of a 9 or 10 or 11% rebound off the bottom of this trough that we dug, that we may stay closer to the bottom during the remainder of this quarter than was expected a couple months ago. So, and that just means, you know, the longer you dwell at the bottom, the further out it looks like it could take to achieve full recovery, unless of course the recovery speeds up. And the one silver lining here is that it's still reasonable to expect that between technological advances like rapid testing, which ought to be deployed right now, and the FDA just approved the first rapid testing, and Ocean IT, you know those guys in Honolulu, Ocean IT, they've made one of these, they're like spit tests, right? You spit in a thing, like a pregnancy test, and you get your result back. So rapid testing, and then ultimately at sometime in the next 12 months, one has to hope a vaccine where enough of us get vaccinated that the anti-vaxxers could go jump in a lake. So here's another aspect of this is really important. You hear people talking about, oh, we need a tax cut. Here's the problem with tax cuts in the environment we're in. In a recession which has been caused by a decline in consumption, these are unusual, but here we are, where interest rates have been taken to the zero lower bound. What tax cuts tend to do in these kinds of environments, and they're not normal, they're very unusual, but the problem with the usual solution, which is let's just cut taxes, is that a tax cut right now actually increases savings, not consumption. And the problem is that consumption and investment have fallen. We need them to go back up. They've fallen because it's reasonable to expect that you could get sick and die. And it's as yet uncertain about when we can go back to our normal ways of business. And we've seen this in the past. So if you look carefully at the slide there, you'll see here's a little arrow. You remember the tax rebate in the spring of 2008? It was sort of the first attempt by the Bush Jr. administration, right? Hank Paulson and the Treasury Secretary in the Bush administration, and the Congress adopted a tax rebate in the spring of 2008. This is after Bear Stearns, but before Lehman Brothers, you know, and kind of went up in the smoke. It all went into savings. People either saved it or they paid down credit card debt, that kind of thing. We saw it with the ARRA, right? There's a jump in the savings rate and a jump outside the sort of normal variation of the savings rate from its underlying trend. We saw it when we saw the reverse of it. Remember when we hit the fiscal cliff at the end of 2012, or we were about to, and the Congress had lowered the payroll tax rate. Sound familiar? But that expired at the end of December. So the payroll tax rate went from 4.2% to 6.2%. So it went up 2 percentage points. Well, the savings rate went down, right? So you would think, oh, if you raise taxes 2 percentage points, consumption is going to go down. No, dude, savings goes down. Savings goes up when you do these temporary tax cuts, and savings goes down even when you do a permanent tax increase, or perceived as permanent increase in that particular case. Why? Because people try to smooth their consumption over time. They use the savings, their savings, or in the aggregate, we use our savings as a shock absorber to pick up the jolts in the economy. And you can see that if you look at retail sales, right? Here you've got a bunch of changes, in particular the one at the end of 2012, a change in the tax code. These are retail sales, retail and food service sales nationwide. And you see how smooth it was all through that period. People just, you know, that's why when everybody buys toilet paper, it throws off the supply chain so badly, because ordinarily people just buy toilet paper when they need it. And you can fine tune your production of toilet paper so that it perfectly matches the absorption of toilet paper, no pun intended, as, you know, the economy grows over time. Now this coronavirus, you know, the COVID-19 event created a huge shock to retail, but even that's now rebounded, or had as of June and July of this year on a nationwide basis. So this event is different from a number of perspectives. I think we'll get through it, but it's going to be some heavy lifting for the next several quarters. And by the way, if it's just Hawaii we're talking about, Hawaii GDP after World War II, Hawaii went, okay, I wasn't born, but people went through the same thing after World War II here in Hawaii. So the only point here, this is Hawaii GDP growth. My point is that it's possible to climb out of a hole this deep and this precipitous and have what we now know in retrospect from the 1950s through the end of the 1970s was the greatest period of economic growth the Hawaii economy has experienced since that time. And why I think there still might be a possibility that from 2020 to 2050, for the next 30 years, we might actually find ourselves in a position a year from now to be at the dawn of the next great wave for Hawaii. And by the way, millennials, I need you to do it so that I can get Social Security. So that's the end of that. So where are we now, and where does that take us in terms of housing? I won't dwell too much, but the obvious statistics for Hawaii are, you know, no tourism. So these are daily passenger counts. Yes, the domestic counts are slowly grinding upward. So maybe if your vacation rental is still out there, hasn't disappeared from the face of the earth, you might have somebody staying there this fall. But until that 14-day quarantine goes away, I'm afraid we're in trouble. Now that now that travelers know what's going on, the 14-day quarantine is a problem. At the beginning, however, the 14-day quarantine came after people had already made their decisions not to come to Hawaii. So that's an important asymmetry to remember. The quarantine is a problem now that it's in place, but remember, people's behavior was driving it. And so to make Hawaii an attractive destination, we need to credibly be able to establish for prospective travelers that this is a safe place to come. And obviously, the impact on unemployment, these are claims for unemployment insurance here in Hawaii by county. You can see how they spiked back in April. The problem now is they've come down, obviously, but now they're kind of stuck in a low-level equilibrium trap, you know, around 5,000 or 6,000. We'll get some new data tomorrow. Well, these are weekly data, but we'll get the the July employment indicators tomorrow, and they'll still show, 10 to 15% unemployment in Hawaii. Was probably a lowball estimate for technical reasons. Okay, let's turn to housing. I need to turn to look at the clock over here. I've used up a lot of time. I'm sorry I haven't left as much for a Q&A, but these structural issues are really important, and especially this part about, something happened in the summer that pushed out the more robust part of our recovery in Hawaii and leaves us in this really tenuous position right now. We need to knock down the spread of the coronavirus in Hawaii, as has been achieved in many of these Sunbelt states that had a problem over the summer. Otherwise, we're not going to participate in the recovery, and we're not going to be able to reopen tourism. We were supposed to reopen tourism this month, and now we're talking about October. So it's like, we got to get this thing done. By the way, you can see a lot of these V-shaped patterns. We just looked at one in retail sales. This is a National Association of Home Builders Index. NAHB and Wells Fargo conduct these surveys. And so this is what people in the housing market are expecting in terms of future sales and prospects for sales. So it's partly about attitudes as well as sales that have recently occurred. And so you can see that this index dropped precipitously in April of this year, but has already rebounded. In Hawaii, we are, however, in a slightly worse position than this. So again, there's right at the tail end, you see there, another V-shaped pattern where housing starts in the US, precipitously dropped and then rebounded to where they were previously. In Hawaii, we were already, pre-COVID, we were already at the tail end of a downward arc in building. These are commitments to, building permits, the unit counts for new residential housing units to be built. So that cyclical turn was already unfolding pre-COVID, and we expected, if you go back and look at the cycles over the last 30 years or so, you can see that the expectation already was that we were going to go into a shallow trough and then maybe, a shallow cyclical recovery in the 2020s. So I actually was relatively, positive, enthusiastic about the 2020s. You can see that the highs are getting lower and the lows are getting lower. So we're definitely in a pattern of lower and lower home building requirements for a variety of reasons, demographic and otherwise, regulatory impediments and so on. But we were expecting a bit of a rebound. So I think if you look right at that COVID point there, at the these are the most recent data for the first half of this year, that big drop in the first half, first quarter, that was kind of pre-COVID, but I mean March was COVID, and then of course April through June are COVID data. My guess is that we too will exhibit a bit of a V shape, but the underlying cycle has to be reckoned with. And whether you look at it, this is Oahu versus neighbor islands, or whether you look at it in terms of single family homes and in terms of multifamily, including high-rise condominiums, you can see that the cycle, whether shallow or of larger amplitude, was already in a down phase in the late 20-teens. And what we were really looking at for the 2020s is a cyclical, recovery of maybe shallower proportions than we've grown accustomed to historically. A final worrisome point about the housing market, these are mortgage delinquency rates, and they are up big time. In fact, if you look at the 90 days past due delinquencies, which jumped, from less than 1% to more than 3% of all mortgages, what that's essentially telling you is a bunch of households lost their primary sources of income back in March and April, and at the end of the first quarter, and at the end of the second quarter, those mortgages had been delinquent for the entire quarter. So the nature of the unemployment, the nature of the job loss, the nature of the furloughs, or the nature of the sudden stop in economic activity in Hawaii is such that a big portion of households are just cut off. This is going to be, it's going to be, now right now, forbearance is the rule, whether it has been the case of rents and evictions, in case of mortgages and foreclosures, that we're deferring and delaying to the extent possible the ordinary consequences of this kind of impairment of income and ability to pay. But we can't do it forever. So working this out, again, as I've said repeatedly, working this out over the coming weeks and months is really, really crucial. We've got to get the coronavirus controlled and got to get things back to a semblance of normality in coming weeks and months, or this ultimately will turn into what it was back in 2009, 2010, right, where the financial crisis created a similar shock, and then you know how long it takes to unravel, the knots that are tied up in judicial foreclosure and whatnot. So hopefully we'll get something in place to move things along. In terms of your market, sales volumes, which were flat to rising modestly. These are seasonally adjusted data. I just smushed it all together. Condos, right? Lots of condos on Oahu selling, not as many condos on the neighbor islands. And then single family homes, Oahu neighbor islands are about the same. You can see reasonable amount of resilience, although it looks kind of partial. We didn't bounce all the way back, and we bounced partway back. And the problem, of course, is we were doing okay in the spring, considering, and now we get into these are July data, and you start to see it's not going all the way back, and you have to be concerned if this second wave, as I mentioned earlier, if this second wave further impairs confidence, investor confidence, and expectations about near-term economic prospects. In terms of valuations, you can see the single family home prices, again, have been more or less resilient. There's a little more weakness on Kauai, which is the dashed line, and on the Big Island. But those could also be within normal ranges of variation. And I've adjusted for seasonality. So I've taken the seasonality out here. I mean, those V-shaped or U-shaped dips really did occur on Kauai and on the Big Island. But of course, they dipped and they came back. So maybe resilience is stronger in valuations. And on the condo side, again, noise dominates over the signal. It looks to me like there's a little bit of weakness here, but maybe there is also a kind of resilience. Maybe vacation rentals are really impairing some of these valuations, or it could be just in the condo market segment where you tend to have more affordability, you tend to have lower income households that are more exposed to the economic risks, and that's showing up in the demand side of the housing market. So again, general tenor of residential resales in Hawaii is, I would still say it is, a pattern of resilience, but maybe only partial, and some vulnerability to where things are going over the next several months. Finally, just to quickly look down the road a little further, and then we'll get to some questions and answers. I've shown you these FHFA data before on long-term valuations, and I tended to highlight, to emphasize convergence to trend, particularly in the 20-teens. This began to fade after 2018, by the way. And these are the most recent data, and you can see now there's more curvature starting to show up. This is statewide data, adjusted for inflation. And in this case, in real terms, for the state as a whole, housing valuations have yet to go back to where they were in 2006. So they would have gotten there eventually in a long-term trend like the one I'm showing here of 2%. And I still feel confident in saying that the long-term trend for real housing valuations is about 2% per year. But obviously there's a shallow cycle that began forming in the late 2010s and now it's actually right at the tail end there. You see it's actually kind of flat. It's not, it just looks like it's curving relative to the trend. But of course, flat is not good when the trend, even when the trend is only 2%, but it's 2% after inflation. So if you just do that, you live in your house and get 2% per year, in real terms. How bad is that? That's, again, probably what we could expect for the 2020s. But here the situation is one of increasing uncertainty about how far below the trend we go, when will it come back? You know, it's likely that the amplitude of that cyclical convergence to trend from below, if it happens, it's unlikely it's going to be a big upswing like we saw in the Japan bubble and in the subprime bubble episodes. But even though we've tamped down the cycle, there does seem to be a strong cyclical component. And here I've just disaggregated that cyclical component from the data. Again, a shallow cycle, I wouldn't expect a big bubblicious rebound, but the problem now is that we've been cycling below trend, and if you pull that trend out, you can see how flat it actually is. So just a caution about looking into the 2020s. We enter the 2020s from a kind of a flat position, maybe at or slightly or moving slightly below the long-term trend. More broadly, we have a pattern of buyership, I should say, which continues to be dominated by locals, less on the neighbor islands than Oahu, but neighbor island markets have become less and less dependent over the last decade on offshore participation. I'm not sure that's a good thing. I mean, you know, it's one of those be careful what you wish for, but that's definitely the pattern. So people who are concerned about that need to stop whining about it. The big change in recent years is the net out migration of residents that has overwhelmed other sources of population growth, natural increase from births, less deaths, and left the population declining for the last 3 years. That pattern of net out migration has occurred mostly on Oahu, where it's gotten bigger, but it's also occurred on the neighbor islands. So there's something deep in the culture and the society that's happening. It's not just military downsizing, although that was part of it. And in fact, it was a big part of it, which is why most of it shows up on Oahu. And that's probably over. We're essentially going back to, post-Cold War military force presence on Oahu. But I wouldn't expect it to change in the 2020s. So again, these deeper issues are going to come through. And what that means for the population forecast is that the projections we had previously of population, this is just Oahu now, but the previous forecasts were higher. And now you have to reckon with a path that's significantly lower, particularly if you're a home builder, right? If we're not going to have 30,000 additional households by the end of the decade, then divide by 3, that's 10,000 houses you don't need to build over the next 10. That's 1,000 units per year you don't need to build over the next 10 years. So I don't know what's going to happen. I'm just saying, you can see from where we're at and what's happened the last few years that the projections we had were too high. And DBEDT now is revising its projections, and we'll get the census data in another year. So it's going to be a real important recalibration moment over the next 12 months. And finally, another thing we saw in the census, the last census, was how much the composition of households had changed over the previous half century. So in the mid 20th century, almost 3/5 of Hawaii households comprised married families with children. And people living alone or with non-family members were only 15% of households. Today, the number of married families with children has shrunk from 3/5 to 1/5 of households. And the proportion of people living alone or people living with non-family members has doubled to almost a quarter of almost a third, I'm sorry. People living alone has doubled to almost a quarter of the population. So that's a shift that means you need more opportunities for independent living, and you need less, new housing for families with children. And by the way, the families with children are smaller households than they used to be as well. Well, that brings us to the end. We've been seeing a renewed exponentiation of COVID cases in Hawaii. We've got to bend that curve. If we do now, it'll take to the end of September. If we let it run and it gets to be like New York in March or in April, or Arizona in July, and February, Florida in July, then Hawaii will take a lot longer to turn that corner. And that could be, Thanksgiving before we get back to starting over. Behavior does shift, and the investor behavior we're most interested in the housing market is the thing we should be most worried about right now, because if Hawaii can't contain the novel coronavirus in its second and more lethal, infectious form, the mortality's gone down. The mortality rate is lower in the second wave than it was in the first wave, but the morbidity is higher. It's affecting more people. So lucky thing in the first case, but problematic in the second. And we've got to create an environment where investors feel confident about the future and will assign value to real estate that makes it worth, committing to buying those properties. In the present, these shifts in behavior, the decrease in consumption, in particular, the jump in the savings rate, are very unusual, and the trick now is to get consumption and quantitatively to a lesser extent, but equally important, investment, physical capital formation or knowledge capital formation, to get consumption and investment to recover over coming quarters. And part of that is home building, which in Hawaii has been in a down cycle, or entering the down part of the cycle ever since the mid-2010s. We thought it was going to have a shallow bottom around now and then move into a somewhat more robust cyclical upswing during the course of the 2020s. But how that unfolds depends on what we do. Meanwhile, existing home sales look relatively resilient, maybe a little weak, but valuations have held up. It looks like the housing market is crossing the chasm of COVID-19 without too much impairment. But the more we delay real recovery, the more vulnerable Hawaii's housing market is to the failure to restore tourism and more generally, the impairment of household income and consumption among residents as a whole. Finally, looking out into the decade, I was reasonably confident about our future. I think we could make a way better future. It's been done before. It was after, the big beatdown in the aftermath and the demobilization following World War II. So there's no reason why Hawaii couldn't do that over the next generation. And there's no reason why the next generation shouldn't just take charge and do it. But it has to be done. It doesn't happen by itself. And that's why looking beyond this chasm and into the next decade is really important from a leadership and planning and investment strategizing standpoint. And with that, I will conclude my remarks and we can take some questions.
Here's a question, Paul.
Yeah.
If the COVID cases continue to climb and businesses continue to operate below normal, do you feel Hawaii's economy can stabilize and recover? Or will the Hawaii economy be damaged beyond recovery?
Well, so there's no such thing as damage beyond recovery. World War did not prevent recovery from occurring. But the question is, how long does it take to get back? And after the World War, it took 5 years. So we don't want that to happen. Although we're starting right now in Hawaii from exactly the position Hawaii was in 1946. Only in that case, we took away the military. In this case, we took away tourism, which is a third of the economy on the neighbor islands and 10 to 15% on Oahu. So do I think that temporary departure of tourism in the economy is going to be permanent? No, I don't think so, because Hawaii looks like this, right? Eventually people will want to come back, but they won't want to come back if it's not a safe place to come back to, and they won't put Hawaii at the top of their list if there are safer destinations that look just like this, to which travelers can return. My guess is that by next year, there's going to be pent up demand like you can't believe. So there's a real prospect here. But the root of the question is where the problem lies. The root of the question was, can you read the first phrase back to me? I want to get this right.
You're talking about
Yeah, the question you just read. Read the
Uh,
first.
if the COVID cases continue to climb and businesses continue to operate below normal, do you
Okay,
feel
stop right there.
Okay.
Do I feel Hawaii can recover? If COVID cases continue to climb and business prospects continue to, or economic activity continue to drop, same thing. They're the same thing. They're not two different things, right? That's the key to all of this. You've got to get the COVID cases to come down, and then you have to not just establish, but maintain your reputation for keeping them down. You have to be New Zealand. You have to be Middle Earth. And when you do that, then the business comes back. So they're the same thing. They're not two separate things. You can't have the business coming back without solving the epidemiological problem. And you can wait till there's a vaccine and hope that enough of us will get vaccinated so that that solves the problem. But that's next year, maybe. And I don't think anybody wants to wait that long. Next question. Good question, by the way. That's the $64 bazillion question.
How are other tourist markets recovering after COVID has declined? Are people traveling as they were? And is there any model to show us tourist behavior going forward?
You know, I'm following this indirectly through some of my colleagues. I do a fair amount of sort of tourism research on my own. I think there's been a first round of this, and Spain's a good example. Spain had a first round. All the Germans went to Spain or Ibiza or wherever, Ibiza, and everybody got sick. And now they. So if you look at Germany's second wave problem, which is about this big, right? When you look at Germany's second wave problem, a big part of it is people who went on vacation in August or July. And so now Germany's just cut off Spain. You know, Germany's just okay, nobody can go to Spain. By the way Germany does this, it says if your case count, if the destination case count is higher than 50 cases per million on a 7-day moving average basis, like they don't have a date. They don't have August 1st, you know, or September 1st, you know, they have a threshold. If you make the threshold, we open travel, and the threshold is 50 cases per million. Where's Hawaii at right now? 200, right? So there you go. This is the difference between rules-based policy and discretionary policy. Discretionary policy relies on the infinite wisdom of our omniscient and fearless leaders, and rules-based policy relies on scientific, mathematical, and data-driven outcomes. If you get the case count down, then we'll let people travel. So my guess is we're going to eventually end up with rules-based protocols anyway, and where you see people having experimented, and Spain is definitely one of those places, I think you'll find, just as, this is my guess now, just as you found in the countries that did their coronavirus mitigation correctly, that is some combination of testing, like every single person repeatedly, contact tracing. I'm not talking about hiring 10 guys out of the 450 people that were trained contact tracers who took the course at the University of Hawaii this summer. They got a grant, trained 450 contact tracers, and Department of Health hired 10 of them. What? I'm talking about smartphones, okay? Testing, contact tracing, and then, isolation and quarantine when it's needed. We have the technology to make it possible to travel safely and have, places along the way, like the TSA, the Transportation Security Administration, that ought to be, the places where if you don't have a temperature, you don't have fever, you go through. If you can demonstrate, if you can spit in a cup and get a rapid test back, in an hour, it's going to take you that long to get your luggage anyway. So I think the protocols will emerge, but my impression is that first wave hasn't been entirely successful. People have had to, 2 steps forward, 1 step back kind of thing. And that the ultimate interim solution will be some combination of rapid testing everywhere, rapid testing before you get off the plane, rapid testing after you get off the plane, tracing or contact tracing or tracking, and I would say smartphones and GPS, and then isolation and quarantine when needed. But there are other variations, right? You can turn a destination resort into a bubble if you want. You could just, use geofencing so that when a tourist leaves Waikiki to go to Ala Moana Center, that they get an alert. Or you could include Ala Moana Center in the geofenced bubble. I mean, there are ways to do this with technology. Why America and Hawaii don't want to try them, I don't understand. I mean, you don't have to be China. You don't have to turn yourself into a surveillance state in order to make it safe for somebody to stay in a vacation rental in Ka'ava or something. I mean, it's not that hard. Look at this picture. So my guess is that's where we end up. But yeah, the first round of guys have had some issues. And the real problem right now for Hawaii is we were in a position to have first mover advantage on August 1st if we had rapid testing and smartphone tracking and all this other stuff, but we didn't, and now our cases are go up. So we go from having first mover advantage to kind of being in last place. Well, there are some advantages there because if you're in last place, you get to learn from everybody else's mistakes. So we get another shot at this in Hawaii, hopefully before the holiday travel season. I mean, right now the target is let's at least get the winter travel back, and let's do it in a way, in a smart way that mitigates our exposure. Because let's face it, the way this coronavirus spreads is on airplanes. Here's another thing to think about. We're still doing everything that we put in place after 9/11, as if a terrorist is going to fly to Molokai and blow up Kaunakakai. You know what I mean? What are we doing now for the next 20 years? That's what I'm talking about. We put in travel protocols after 9/11 that basically say we treat everybody, because everybody could be a terrorist bomber, we treat everybody as if they are a terrorist bomber. Okay, the principle here is because you could be an asymptomatic super spreader of the novel coronavirus, we treat everybody as if they are an asymptomatic super spreader of the novel coronavirus. And then you go. Then nobody's going to blow up an airplane. Nobody's going to get coronavirus, and then a year from now, the rule will be, did you get a vaccine? If not, spit in this cup. So, it's how we do it that matters. And yes, I think a recovery is possible. There's no reason we permanently have to be stuck like this. But the point is to have it sooner than later. Do we have time for another question? I feel like we're running out of time.
Okay, let's do one question, and then there's also a clarifying one, but let's do this one. Forbearance is up and delinquencies. Do you see a flood of housing foreclosures by the end of the year beginning 2021?
Again, it's one of these things, what happens at the tail end of this as we push through 2021 depends on what we do in the interim. And so, for example, on August 1st, Congress went home. It's like, what do we need those guys for, right? Did they extend, the support for unemployed individuals? No. I'm like, okay, so that's it. We're just everybody sink or swim. You're screwed. And so, trust me, the next couple months is hitting the fan right now. So that's probably not the way to do it. And by the way, economists from the left to the right end of the political economic spectrum are largely, almost universally in agreement about this. This is the time for fiscal policy intervention in significant magnitudes. 1 trillion is probably not enough. 3 trillion might be too much. How about something in between? It's not that hard. But this is where we are. And as a consequence of that, we're closer now, or over the next couple months, pending what Congress does or doesn't do, to the kind of catastrophic outcome to which this question alludes. But the way things are supposed to work is that we sort of temporarily put something in place, and then later we got caught up. So now the question is, are we going to forgive the PPP loan, or are we going to have you pay it back? Are we going to forgive the rent or the mortgage payment, or are we going to pay it? Are we going to take that amount and amortize it over the next, for the remaining life of the mortgage? right? And have you pay a little more? I mean, there are ways of restructuring everything. And we're talking about, in many cases now, we're talking about fintech. We're talking about changing the code. We're not talking about, having a loan committee meet, but there are ways of taking the problem we created and solving it so that we don't reach the catastrophic situation to which this question alludes. Otherwise, we end up in judicial foreclosure, and nobody wants to end up in that situation. We're still litigating problems from the 2008 financial crisis. Not that much, thank goodness, but trust me, there are still cases going on where people are trying to sort out, all the loose ends from that period. So the answer is there is a way to get us in position for a reset before the full force of a tripling of 90-day delinquency, right? If 90-day delinquency quadrupling went from 0.7 to 3.33%, so call that 5 times 7 is 35, that's a quintupling. You don't want it to go to 6% at the end of third quarter. You don't want it to go to, right? You don't want the next 90 days of people to jump in on that. So we do, we've got to get something going here in the next few months. It's not, the problem is not that we can't afford to do it by borrowing from the future. This is what you do when there's a world war. This is what you do, and it takes a couple decades to pay down. When there's a global pandemic, this is what you do. It's not that these are inappropriate interventions. The nature, the scope of the economic problem, a third of the economy on the neighbor islands went away before resident consumers reduced their consumption. 1/3 of the economy just went away instantaneously, and then residents lowered their consumption. So, the sheer magnitude of the size of the negative impulse requires a countervailing collective fiscal policy response of a similar magnitude. We did the same thing in the case of World War II. So it's not that we don't know, what needs to be done. It's that the details now are really important. We did the blunt instrument with the CARES Act. Congress will probably come up with another blunt instrument intervention somewhere between $1 trillion and $3 trillion in the course of the next. I fully expect them to come up with something over the next several weeks. That's not the problem. The problem is the next 6 months to a year to 18 months, figuring out the back end of this. And like I say, I think a lot of it's going to involve, if not outright, PPP loans came with a forgiveness option, right? That's why people could borrow the money. So somewhere between just straight up forgiving the loan and amortizing, right? This is how you solve debt crises all the time. You just amortize over a longer period the resulting shortfall and try to get everybody back. Because once you don't have to worry about dying, you can just go back to the way things were in December of last year. Like that. Once you don't have to worry about dying. So there's a way to get there, and it's going to be the creativity of, the smart kids who are learning, financial economics today, that are going to be a big part of, how we navigate. You said there was a clarifying question?
Yes. The question is on slide number 46. It says single family in header, but condo in graph. Your narration referred to single family.
I do that all the time. It's so hard, these things, this spaghetti, brother. I tell you, you put the data together. Look at this stuff. Are you serious? How do you keep track of that? Don't even ask me. I try to color code it. I get, so let's see, 30, which one?
46.
Oh, I was just on it or something. Yeah, let's see, 1, 2, 3. Yeah, these ones, nightmare, bro. I did these last night. By the way, these data aren't published yet. They'll be published tomorrow, so don't tell anybody. Don't tell anybody where I got them. 4, 5, 6. Okay, what is this? I know, right? Okay. Okay, so this should say, hold on. I will fix it right now. Yeah, this one is just supposed to say Oahu. Right, so now let's try this. That's just Oahu. And so when I do that, and then I go here, and then I share a screen, and then I do that, and I do that, you never know what happened. I think this is single family. Either I corrected it or I made everything incorrect. I think this is single family, and I think this is condo. Wait, click condo. Yeah, I know this is condo. This is your brain on drugs. Trust me. I had in the corner, I used to have a little square that said, well, if you take the standard deviation as a percentage of the mean of each of these prices, and I thought, well, that's not right. We should detrend it. So then it was like the standard deviation of the log changes divided, forget about it. That thing makes zigzag, okay? It's condos, it's noisy, and single family more smooth. That's the technical. Single family more smooth, condos stay zigzag. That's technical mathematical economics for you there. Single family, all smooth, condos, your brain on drugs. These are prices, volumes. Got it? Clarified?
Thank you,
Yeah,
Paul.
sorry about that.
Well, I think that's a wrap. Well, Paul.
Shoots.
Shoots.
Aloha,
Mahalo.
thanks you guys.
Mahalo. Stay safe, everyone, and healthy, and have a great week.